Financing is often the biggest hurdle for buyers and the transaction element that they are least sure of. Local lenders may be more attuned to approving mortgage loans because they are familiar with the area, developments, and properties. You can help buyers by sharing knowledge of local lenders and examples of how other buyers have financed purchases. Local lender financing. When the property is located in another area or state, it may be best to seek mortgage financing through local lenders because their loan officers will know the local market. Buyers might look to a local branch of their home bank for financing. Private mortgages and seller financing. If a buyer cannot meet down payment requirements, but can afford payments, seller financing may offer a solution. A strategy to consider is a combination of a 75% first mortgage, a 10% down payment, and seller carryback financing of 15%. This strategy is allowed by the secondary mortgage market, which purchases second home loans, and may enable a buyer to avoid private mortgage insurance, PMI, because the first mortgage is less than 80%. A private mortgage made by a relative or friend and secured by the property is another possible strategy. A properly formalized mortgage, serviced by a professional, accords the lender the same rights as a lending institution in the case of default. For the borrower, the loan's interest is tax deductible. The relative or friend making the loan can set a higher or lower rate than a bank. The private mortgage between family members keeps the money within the family and offers flexibility. Payment amounts and due dates can be adjusted or forgiven as the lender sees fit. A handshake or verbal agreement are not enough even between close friends or family members. An attorney or accountant should handle formalization of the agreement. Involving a neutral third party may safeguard personal relationships. On the downside, the personal relationship can suffer if the borrower is erratic in making payments. Condo loans. Reacting to big losses sustained during the wave of foreclosures resulting from the subprime mortgage market meltdown, FHA along with Fannie Mae and Freddie Mac tightened lending standards for condo loans. Under current rules, both the borrower and the condo development must pass muster, even for current owners who want to refinance. The GSEs want to see a financially and structurally sound condo development with a high percentage of owner occupancy and low percentage of delinquency on fees. In 2022, new temporary requirements were put in place to ensure that GSEs do not purchase loans secured by properties with significant deferred maintenance, unsafe conditions, or not enough cash reserves to fund structural repairs. These requirements are expected to become permanent. GSE standards are somewhat more liberal than FHA, which does not guarantee second home mortgages. Fannie Mae and Freddie Mac condo rules include, more than half of the condo units must be owner-occupied. No single entity, the same individual, investor group, partnership, or corporation, may own more than the following total number of units in the project. Projects with 5 to 20 units, 2 units. Projects with 21 or more units minus 20%. No more than 15% of the units can be more than 60 days delinquent on association dues. For new developments, 50% of the units must be conveyed or under contract to an owner-occupant. The total space that is used for non-residential or commercial purposes may not exceed 35%. Condo and coop hotels or similar commercial entities are not eligible for financing. Condo developments in Florida must meet additional conditions and qualify through the FNMA Project Eligibility Review Service (PERS) process. Updated guidelines for Fannie Mae and Freddie Mac require lenders to take a closer look at the structural integrity, cash reserves, special assessments, and deferred maintenance for condos and co-ops. Many lenders are requiring that condo associations fill out a questionnaire to assess financial and structural integrity of the project and if it meets eligibility requirements. Local lenders will be up to date on which condo developments in the market area lack GSE approval. A buyer who wants to purchase a unit in an unwarrantable condo development, one that doesn't meet GSE standards, will have a difficult time finding financing. A few more facts. For manufactured housing, the retail sales outlets usually offer personal loan financing. When permanently affixed to a foundation, the manufactured home can qualify for conventional mortgage financing. FHA and VA loans are not available for vacation and second homes, and investors cannot finance purchases through these programs. Just as for a primary home, the purchase offer for a second home should include contingencies for obtaining suitable financing and appraising for at least the purchase price. A good fit now and future? Buyers looking for a property in anticipation of retirement should consider how the home will fit not only their future lifestyle, but also their income and savings. Will the property still be affordable on a retirement income? They might pay all cash for the property, if that is a possibility. Or they could mortgage the property with the intent of paying off the loan with cash at a later date closer to retirement, possibly from the sale proceeds of their primary home. Ownership of vacation and second homes. A vacation or investment home can be owned in the same form as a primary residence. The simplest and most common form is fee simple ownership by one individual or jointly by two individuals with right of survivorship. On the other hand, shared ownership, especially among non-family members, complicates the situation and may require the advice of a legal and tax counselor. Forms of ownership available vary among states, but following are some common options. Ownership in severalty. One individual or legal entity has sole ownership right and discretion over the transfer of the ownership. When neither husband or wife owns property in severalty, state laws regulate how that ownership is held. Co-ownership, tenancy in common. Each tenant holds an undivided fractional interest in the property, not to be confused with securitized PIK properties. Joint tenancy, each tenant has the right of survivorship. A tenant's property ownership cannot be bequeathed to someone else, it automatically passes to the surviving joint tenant. Tenancy by the entirety, a state provision defining the right of survivorship for married couples with each spouse having an equal, undivided interest in the property. Corporation. Based on state law, some corporations are permitted to purchase real estate for any purpose, whereas others may only purchase properties consistent with corporate purposes. Partnership. The Uniform Partnership Act and Uniform Limited Partnership Act are valid in most states. The partners should hire an attorney to prepare an agreement specifying the details of property use and buyout provisions. The designated managing partner should probably receive compensation or a higher percentage of the ownership. When forming a partnership, it is best if all of the partners have the same investment goals and comparable financial strengths.